Good morning, welcome to Ainslie News this Thursday, 6th of August 2020. Back to talking gold and silver today. Gold doesn't yield and doesn't need to. For the big money, US Treasuries have always represented their main go-to free trade, the place to put their money. Whilst essentially buying debt, the fact is it is backed by the US has meant it is still perceived to be risk-free. Over the last few years, it has been one of the best trades for macro investors. However, even bond bulls are now raising serious doubts as to the merits of bonds when their yields are essentially already zero bound. Remember when you could buy a bond note, the price you pay is inversely proportional to the yield it returns. As interest rates have headed to zero, the price of these bonds has risen. But where to from here is the question on bond traders' lips. As we've shared many a time, the correlation between the gold price and the real rate on bonds, i.e. the yieldless inflation, has been incredibly tight, as you can see in the following chart. Gold versus the 10-year real rate. Sticking together very closely over these years. Since 2009, we can see that correlation. We are now in the space where real rates on the benchmark 10-year Treasury is negative 1%. That, of course, is bullish for the competitor gold, which pays no yield. When faced with two choices for safe haven, Wall Street types and probably your financial advisor have said, gold is not an investment, it doesn't yield, and have favoured bonds over that pet rock. They like to call it pet rocks don't pay trailing commissions, etc., like managed funds. The difference, of course, is that one is a debt instrument, piece of paper with a counterparty risk, and the other has intrinsic value and no paper promise, and now has an even playing field with real rates and bonds now negative. Moreover, the background has changed with the level of central bank and government intervention, and this from Bloomberg. Spurred on by real yields at record lows and monetary dangers ahead, asset allocators are primed to start ditching some of their government debt holdings. The theory goes, given the size of the fixed income universe, it wouldn't take much to power the gold price to fresh and dizzying highs. Managers like Plurimi Wealth LLP's Chief Investment Officer Patrick Armstrong are a case in point. Armstrong has cut back on bonds and now holds 7.5% of firms' balanced portfolios in gold, the most ever. He also started buying gold mining equities in March. The allocation shift is an about turn for the investor who was shorting bullion 5 years ago when prices languished near $1,100 an ounce compared to the $2,040 per ounce today. The reason I want to hold gold is because the future is going to be a continuation of what's happening now. More money printing, he said. As we reported earlier this week, even after this rally and the record amounts flowing into ETFs, the proportion of gold in portfolios is still below the 2011 and 2012 highs. Bloomberg also notes, gold positions in ETFs and the COMEX represent about 0.6% of the $40 trillion it's invested in funds globally, according to data from UBS Group AG. That's less than the highs from the last gold market peak in 2012 and 2013. Just returning to the peak would mean purchases of more than 81 million ounces. Positions could easily double without the allocation looking extreme, Joni Teves, a strategist at the bank, wrote in a report. She cautioned that her analysis isn't an estimate for future gold allocation, but it illustrates how a small increase among a wide pool of investors could have a major impact. There's even more reason for managers to consider gold, with the US 10-year real yields, which strip out inflation, plumbing new lows near minus 1% this week. We see gold as providing better risk-reward characteristics than treasuries in such inflationary environments, said Guillermo Felices, head of research and strategy at BNP Paribas Asset Management's multi-asset, quantitative and solutions team. The lack of yield problem for gold can easily be stripped out by levelling the playing field. The chart next shown gives us an indication of the performance for main Aussie asset classes over the last 15 years. It builds in dividend reinvestment plans for shares to include yield. It includes rental yield on property, and it includes interest on a term deposit for cash, or compounding. Gold and silver, of course, have no yield, so their growth is just capital growth. As you can see, the pet rocks of gold and silver have very easily outperformed every investment over the last 15 years. You can see that it does particularly well when those brown and red lines dip, housing and shares. The big question is now, how big will the next dip of house prices and shares be, and what will happen to gold and silver when it does? Have a brief look at this chart here. Relative performance of investments, 15 years. Check out that peak of silver there around 2011, 2012. Absolutely amazing. And it looks like gold and silver are off to a pretty quick start here in 2020. Okay, that's news for today. And jump over to ainslieBullion.com.au for all things gold and silver, Ainslie Wealth for all things crypto, and also check out our gold and silver backed tokens built by Ainslie over on goldsilverstandard.com. We'll catch you tomorrow for more news.